Welcome to this explainer. Look, if you're working in multinational finance, you already know the drill. Managing subsidiary reporting can honestly feel like running on a treadmill that literally never stops. Just picture those late nights during close week, right? Your team is endlessly crunching data, trying to reconcile local statutory numbers with group consolidation requirements. It's an incredibly heavy lift. But there is a major shift coming to ease that burden. Today, we're going to explore exactly what this new standard does, why it's dropping right now, and how it's going to act as a massive strategic pressure release valve for your overworked finance teams.
All right, here's our roadmap for today. We'll cover the IFRS 18 problem, introduce IFRS 19, look at what changes and what stays the same, figure out who's actually in scope, bust some common myths, and finally, wrap up with the strategic takeaway. Let's get right into it.
Starting with Section 1, the IFRS 18 problem.
So why does IFRS 19 matter right now? I mean, with everyone obsessing over IFRS 18's new presentation frameworks, why throw another standard into the mix? Well, to really appreciate the solution, we first have to look at a massive historical inefficiency in how multinational groups have been managing their data for years, and frankly, the breaking point we're rapidly approaching.
You know the drill. For years, subsidiaries have just suffered through duplicated reporting. They keep one track going for local compliance and then a completely separate full IFRS track just for group consolidation. It's one of those quiet, really expensive inefficiencies of multinational reporting. You've got two reporting tracks, two completely different disclosure logics, and all these recurring compliance costs that offer practically zero benefit to the actual end user. The subsidiaries bear this huge reporting burden of full IFRS, but they aren't even serving the same capital market audience as their listed parent companies. It's frustrating, right?
And here is where the problem really escalates. IFRS 18 fundamentally reshapes the whole design philosophy for presentation and disclosures. We're talking new requirements for operating profit, management performance measures, strict category structures, you name it. Because of this, full IFRS becomes even heavier and way more granular. So, without some kind of pressure relief valve, the costs for smaller, unlisted entities to comply with all these new group-level granularities, well, they'd be absolutely staggering.
Moving on to Section 2, enter IFRS 19.
Let's see how this builds into a targeted, modern solution. The crucial point here, if you take nothing else away, is this one-sentence anchor. IFRS 19 is not the successor to IFRS for SMEs. Instead, it is a standard specifically designed to redesign the disclosure burden in the IFRS 18 era. It gives us a lighter disclosure version for eligible entities that want to, or literally have to, apply full IFRS for group consolidation, but just don't need to publish a massive novel's worth of notes for their local users.
Think of it like a disclosure overlay. Imagine taking a much lighter dashboard and placing it right over your exact same accounting engine. It keeps group consolidation perfectly intact, but it strips away all those complex capital market disclosures that your subsidiaries' users just don't care about. The main objective here is proportionality. IFRS 119 basically assumes the new design philosophy of IFRS 18 and simply exempts the parts that would just be complete overkill for eligible smaller entities.
That brings us to Section 3. Disclosures change, accounting remains.
Now, this next concept is probably the most misunderstood part of the whole implementation. We really need to understand exactly what changes and what stays exactly the same. Under the hood, your recognition and measurement, things like your lease liabilities and revenue, they remain completely fully intact. But that hefty note pack you prepare at the end, that gets significantly reduced. So when you're explaining this to your stakeholders, the easiest way to frame it is this. It's not the way the numbers are made that changes, but rather the amount of notes that must be prepared. The accounting engine remains firmly full IFRS.
This breakdown brilliantly illustrates the proportionality at play here. As you can see, we're removing dense sensitivity analyses while retaining the core numbers required to actually understand the financial position. Take qualitative narratives, for example. You can ditch those lengthy risk management strategy descriptions, but you still have to retain the basic accounting policies necessary for user understanding. Or look at leases. You drop the deep portfolio descriptions and maturity details, but you absolutely retain the lease liabilities, right-of-use assets, and depreciation. Oh, and remember, IFRS 19 sets a floor, not a ceiling. If these reduced disclosures aren't quite enough for users to really understand the entity's position, you are still on the hook to provide additional notes.
All right, Section 4, who is in scope?
Of course, this relief isn't just handed out to absolutely everyone. So let's look at the strict eligibility filter. To apply IFRS 19, a subsidiary must hit all three of these mandatory conditions. And keep in mind, this election is made on an entity-by-entity basis. First, and absolutely most importantly, it must have no public accountability. Second, it prepares its financial statements under IFRS accounting standards. And third, it has a parent that produces publicly available consolidated financial statements under full IFRS. This actually means one subsidiary in your group might apply IFRS 19, while a sister company right next door might not. And you have to monitor this continually too. If an entity suddenly gains public accountability, boom, it immediately loses its eligibility to use IFRS 19.
This high contrast view makes it super simple. If you hold assets for a broad group of outsiders, we're talking banks, insurers, investment funds, or if you trade publicly, you are out of scope, period. But unlisted operating subsidiaries, they can take full advantage of this relief. Now, what if your unlisted subsidiary just happens to post its financial highlights on a website voluntarily, maybe to build trust with vendors? That actually does not disqualify it. They are still perfectly in scope. Public accountability is strictly defined by public trading or fiduciary status.
Okay, Section 5. Common IFRS 19 Myths.
Because this standard interacts with so many others, let's do a quick rapid-fire sequence to bust some common myths. The absolute most frequent confusion we see among finance executives is this question right here. Is IFRS 19 the exact same thing as IFRS for SMEs?
The emphatic answer here is no. IFRS 19 retains the complex full IFRS accounting logic. It doesn't just swap it out for simplified SME measurement rules. Think about it. If you adopted IFRS for SMEs, your actual accounting calculations, your ledgers would physically change. But under IFRS 19, your ledgers remain exactly the same as your full IFRS parent company. You literally just print fewer notes at the end of the year.
Here's another great question we get. If we adopt IFRS 19, does our accounting actually become simpler? Like, does this give your subsidiary controllers an easier time calculating the numbers? Will their month-end close suddenly be faster? Well, while the amount of notes that must be prepared drops drastically, the way the numbers are calculated doesn't change at all. The main point is lighter disclosures, not simpler accounting treatments. Your accounting team still has to run all those complex calculations for IFRS 15, revenue recognition, IFRS 16, leases, and IFRS 9, financial instruments. The actual relief comes at the very end of the reporting cycle, when they sit down to draft the financial statements. They just simply don't have to write up all those expansive capital market disclosures.
Here's the last question in today's video. Once IFRS 18 is implemented, should companies always evaluate IFRS 19 together with it? The short answer is, not always, but if your company is eligible, the value of evaluating both together becomes much higher. Since IFRS 18 already forces you to open up your accounting system and change how your subsidiaries gather and report financial data, it is the perfect window of opportunity to implement IFRS 19. By doing both at once, you can redesign the system to collect less data from your subsidiaries, saving massive amounts of time and labor. The two key decision factors are eligibility and strategy. 1. Eligibility. IFRS 19 cannot be applied by listed parent companies. An entity is eligible only if it is a subsidiary whose parent company prepares consolidated financial statements under IFRS, and it has no public accountability. Factor number 2. Strategic objectives. Even if your subsidiaries qualify for IFRS 19, a corporate group might decide against it based on strategy.
Finally, Section 6, the strategic takeaway.
Let's wrap up this explainer by looking at how you can really weaponize this standard for your corporate strategy. As you can see on this timeline, aligning your IFRS 18 implementation with the January 1, 2027 effective date of IFRS 19 is absolutely key. It allows you to absorb the new presentation rules without replicating that massive disclosure burden everywhere. For parent companies, implementing IFRS 18 is non-negotiable. But for subsidiaries, the message is totally different. Their accounting logic has to remain aligned with the group to preserve consolidation integrity, right? But their standalone reporting absolutely does not need to mirror the full disclosure architecture. The real strategic move here is to adopt IFRS 19 at the exact same time IFRS 18 goes live.
So, I want to leave you with this provocative thought. IFRS 19 isn't some exit from IFRS, it's a strategic calibration of it. Are your internal systems really ready to handle this new era of proportional reporting? Can your chart of accounts and reporting software cleanly separate the full IFRS accounting engine from the lighter IFRS 19 disclosure layer for your eligible subsidiaries? The standards have officially provided the relief valve. Now it's entirely up to you to build the architecture to capture it.